Don Kaufman here, doing the TheoTrade weekend update, February 18th, 2022. We are just minutes after the cash close here on this Friday afternoon. More tumultuous volatility hitting the tape. In fact, tape bombs all over the place throughout the course of this week. I'll explain that and much more here in just a moment. But the ultimate question is, are markets just headed into the selling abyss? Everywhere we look in this marketplace are some absolutely critical kind of inflection points. Everything from the S&Ps to the NASDAQ to volatility poised to break out to the upside, dollar poised to break out to the upside. We're going to look at all of it here on this weekend's update. First and foremost, let's actually quantify the statement. It's just a tape bomb kind of a week. And that has everything to do with some of the geopolitical risk. Obviously, Eastern Europe is just a constant threat to the tape. Throughout the course of the week, when I'm talking about in terms of tape bombs, well, look no further than some of the overnight trade, and you'll know exactly what I mean by tape bombs. Everything from wild up moves to just absolutely vicious down moves seemingly coming out of nowhere. Well, they're not out of nowhere. This is what I'm talking about with the tape bomb. And this kind of tape bomb is what can just destroy intraday traders. Now, granted, what I'm looking at here first and foremost happened in some of the overnight trade. But any of you that executed anything on an intraday basis throughout the course of this entire week, you've been threatened, okay, consistently by these tape bombs. And it's just, listen, you know, what do I quantify as a tape bomb is any piece of news, tweet, whatever it may be. Specifically this week, it was coming out of Eastern Europe. But that's not to say the Fed had a couple of their own announcements this week. I mean, the Bullard made a couple of comments that shook up the tape. You got to be on your risk management game if you're going to be involved on any degree of an intraday basis, because, you know, I'm looking at the S&Ps right now, but that just doesn't even do it justice. I mean, you gotta kind of recognize, rationalize, if you will. The NASDAQ in overnight trade was trading at 14,300. An explosive move occurs from 14,100, straight shot to the upside. We turned completely around in the morning. We actually touched down to 13,900. Wild and expansive ranges are just everywhere. I mean, that's kind of what I mean by that tape bomb. And again, you know, I'm going to argue throughout the course of this entire next week of trade. And of course, we're coming into a holiday weekend. We're going to have Monday where the futures market will be partially open. The equity, okay, and bond markets are closed. So we're coming into President's Day weekend. Nevertheless, I think you can anticipate that some of this, if you will, tape bombing, it's not going to go away. And in the coming week, I'm less inclined to think about Eastern Europe, more inclined to think about some of the economic drops that are going to be happening that are just, I mean, literally going to be rocking this marketplace back and forth. So again, that constant kind of threat to the tape, tons of Fed speak. The other aspect that we had going throughout the course of this week, and I'm going to give you just a kind of a brief market update of a few sectors. And the other real consistent threat happened to be, it was just like a really tough argument throughout the course of this trading week. Why would you want to be long? And I say that as more of a question than a comment. Why would you want to be long coming into this weekend? There's just so much geopolitical risk, so much economic risk, especially into a long weekend, that we couldn't make any rational arguments to want to be long. I mean, throughout the course of the week. And that's something that I actually pointed out on Wednesday night's video is, you know, listen, expect a lot of volatility. No one wants to go home long into the long weekend. And the irony of that is the mass amount of any sell side activity that actually occurred didn't really happen on this Friday. It actually happened on Thursday. So some pretty strong sell side in the market on Thursday, but none of this looks like it's capitulation. And that's largely predicated on what I see inside of the action of the volume. But before I go any further, okay, I actually want to look at some of the sectors and some of the damage kind of inflicted in some of the sectors. And for that, We're just going to cruise over, for instance, to the spiders. With spiders, we're actually going to apply auto expected move. The spiders actually finished lower, of course, on the week. Did not touch the lower edge of the expected move. If you look at the QQQ obviously lower on the week. Did not touch the lower edge of the expected move. All right, what else do we have? We can start looking at individual stocks. But before I get there, I want to actually look at the energy sector, which actually slightly outside the lower edge of the expected move, and financials finishing on the lower edge of the expected move. That, people, it's actually quite critical. Keep this in mind. Financials, which have been incredibly strong as of late. Energy, incredibly strong as of late. Those are now your weaker sectors. That's going to come up once again here on this weekend's update. All right, the other aspect that really resonated with me, okay, to kind of give you just a quick market update, we're actually rotating now back into bonds. This is clearly, it's a duck and cover shift back to bonds. It kind of goes with that argument. It's like, hey, why would you want to go home long? And of course, somebody's going to make the argument, well, there's going to be just an explosive rally coming into early next week. Maybe. There could absolutely be some short covering coming into early next week. Nevertheless, okay, the amount of geopolitical risk that you would sustain, okay, and I just stress that the amount of geopolitical risk that would be sustained coming into this week of trade, it's literally beyond anything that I would want to sustain over a weekend, and outweighs, okay, the ability, if you will, for that market rally. So I don't want to discount the ability for the marketplace to rally by any stretch of the imagination to early next week. I just think that you have to actually be concerned for that downside, okay, which literally is what I would term into the selling abyss from this point. Anyway, the move in the bonds, I think it has to intimidate really any long trader in this marketplace, because this is the real first sign of some duck and cover. And I think the irony of that, it's just the beginning. I mean, literally, we've had 3 days of movement, possibly only 2 days of real movement to the upside in the bond market. But you kind of get that feeling like when there's nowhere else to go, nowhere else to run to, nowhere else to hide, we actually turn around and buy bonds. You think about bonds with interest rates this low, inflation absolutely soaring, who would want to buy bonds? And the answer is, okay, anybody that's got some very serious capital. There's nowhere else for them to run to. And this is where somebody always screams, what about gold? There has been some movement into gold. There's no question about it. Okay. But this is not going to be a great duck and cover product, especially when we start talking about the dollar here momentarily. All right. Inflation kind of took a little bit of a backseat throughout the course of this week because, as I said, Eastern Europe was obviously in focus. But, okay, what I'm going to talk about here momentarily is when we look at markets, and again, I'm just going to generalize for a moment here. I'm going to bring up a 30-day, 1 hour inside of the S&Ps. And this is something I've talked about just incessantly, and that's this, okay? There is this incredibly, okay, vicious volatility box. We were in it in late January, okay? We are once again right in, okay, kind of the central portion of this particular volatility box. And this is where things can get absolutely wild. There's no question. Again, we could bounce, we could rip. All right. One last hurrah, maybe just up, okay, just shy, if you will, of 44.50. But there is no question right at this particular level. Okay. This is where we can actually rip lower and retest some of the lows. And I'm actually going to show you why. Okay. We believe that not only are we going to retest lows, all right, but I'm going to give you very specific levels to be watching for as what I term, again, the edge of the market abyss. Now, the next aspect that I want to bring up before I go too detailed back into some of the levels is that it's strictly, in my opinion, there's going to be, okay, significantly more economic data on the very near horizon. In fact, it's worth kind of exploring, this advanced decline line here, though. You can explore, okay, the economic calendar for yourself. Each and every week is going to bring, okay, a fun-filled fantasy, if you will, of economic data coming out. All right. If people ask, is there anything in particular? I mean, sure, everything from GDP and so forth, but any of the economic data that would display, if you will, the slightest degree of inflation, I think we're going to have some serious tape issues. Okay. Here's the opinion portion. I believe inflation is going to absolutely explode in the very near term. Now, I am not necessarily justifying, okay, this next week of trade. Again, we're going into a holiday weekend. We're going to have 4 days of trade next week. I'm not necessarily proclaiming that, oh, this next week, that's it. Inflation's going to explode. In the next 6 to 8 weeks, I believe that you are, in fact, going to hear of an explosion, okay, in inflation, which is in very large part going to change the way you feel about this marketplace. Now, let me give you a little bit more background than just saying inflation's going to explode. I'm going to bring up the TNX, okay, which happens to be none other than the 10-year. So the 10-year, kind of crested here. This is the interest rate associated, just north of 2%, okay? So our 10-year hits just north, okay, of that 2% marker, kind of contracts a little bit. All right, why do I actually think that, again, the interest rates, all right, are going to play heavily into this? And why do I think, moreover, that inflation is going to explode? Has everything to do exactly with rates, okay? This feels like the last call for low rates, a last gasp, if you will, inside of the marketplace, right, for low interest rates. Everything from the housing market, okay, to large ticket items, everything from cars, all right? If you can get it, and you can get it at the lower interest rate, people are reaching for it right now with supply constraints, okay? Interest rates on the rise, which is in everybody's face every single day. It's one of the reasons, again, there's going to be a short-term absolute burst to the upside of inflation. The issue therein lies, it's very likely to kind of panic the Fed. So those numbers are going to panic also investors. They're going to panic traders everywhere, okay? Rates, yes, they've gone up, but rates to me, it isn't, okay, center stage. It's the inflationary pressures surrounding this. And I think, again, the interesting irony of this is inflation, all right, is hitting us hard right now. The S&Ps are selling off, and yet we're actually now buying bonds, which is taking rates even lower. Nevertheless, okay, on Main Street, right, where you're actually buying items in the real world, it's a last gasp, a last run, if you will, on products, okay, high dollar products, to get those ultimately before rates do increase. So keep it in mind in the days to come. Now, that's one of the reasons where I think we're on the edge of the market abyss, but that's not necessarily this next week of trade. You're looking at the next, month, as I said, to 6 weeks out to kind of, head into that abyss. So let's get to specifics at this point for key levels. All right. I'm going to come back for a second to the S&P and NQ. I want to start with VIX. Okay. Take a look at VIX. So VIX is poised to do what? Just below the 30 level. People, we are coming up and we are ready to rock. Now, VIX doesn't exactly hold a near and dear place in my heart. When I'm looking at volatility, okay, I more or less look at vol futures and get a read, okay? And I think it's much more instrumental about how serious the implications of risk happen to be. And if you take a look at like March volatility futures versus what we term April and May, the March volatility futures, so we'll just label them here. MAR is sitting ultimately at 28. Come a little further out in time, for example, to April, and that's 27.18, even further out in time, and you actually drop. We are in a very heavy, at this point, we're in a backwardation. And what that implies is that the here and now, there's actually more risk in the next 25 days than there is in the next 61 days than there is in the next 89 days. And it's one of the most critical aspects to understand that this also changes, if you will, how the entire professional trading arena, okay, mitigates exposure. So you've already got, VIX is poised to break above 30. Okay, and you're like, yeah, whatever, man. I saw VIX even higher than that just a couple of weeks ago. I get it. But as I've used this terminology time and again with people, like, markets are like a very scary movie. And this is why I wanted to cover VIX a little bit first. Markets are like this scary movie. The first time you see a really scary movie, okay, here's a really scary movie. In this scary movie, we go to 4,200 and then we bounce. In this scary movie, Well, we've already seen 4,200. So we get to 4,200 again. Risk doesn't need to go as high, right? So if you're looking at VIX and you're looking for VIX to burst to the upside, you're not going to get VIX bursting to the upside because the VIX is just like that. It's seen the movie already. So VIX is creeping up and it's poised to explode higher. But you're not going to see Mr. VIX over here explode to the upside unless the S&Ps, they got to cross through 4,200. And that's when you're going to be like, you want to see something really scary? That's when it's going to explode. But at the exact same time that I'm saying this, the inversion in volatility, okay, is actually slightly larger than we've seen, especially going into a holiday weekend. It's alarming. It really is alarming. I mean, I know everybody's like, oh, but volatility is down today. Yeah, volatility is down with the S&Ps down. Nevertheless, though, volatility, it climbed quite a bit, on Thursday and just, ending the day massively unchanged here on a Friday. But the key, it isn't looking at VIX. It's looking at the volatility inversion. And again, it's put on your big boy pants because it's large. All the other volatility indications are basically flat in today's trading session. All right. Onward and upward from there. So where do we effectively go from there? Well, that's where I said I'm going to jump back to the S&Ps for just a second. Fairly confident in everybody's understanding that on the lower edge, one of the key thresholds here is this 4,200 level. Okay, and I'm rounding. I mean, specifically that line that is on the screen, on my screen. Okay, that line that kind of, goes across the screen there, that is at 42.11. But again, I want to write up very, very specific levels here. This 42.11 is critical. The interesting irony is we're also sitting right in almost the middle of the volatility box at about 43.50. We're basically halfway home at this point. And this is where we believe, even if there is a short-term bounce, it would be just that. It would be very short-term before we actually descended upon the 4,200. Okay, so I think what's most interesting about this, we closed right on the key inflection point. I mean, 43.50 couldn't get it done any better. At the exact same time, something I've been talking about also just incessantly, week in and week out, if the NASDAQ gets under the 14,000 level, okay, I mean, I'm going to say this as eloquently as I possibly can. The NASDAQ under the 14,000 level, all hell will break loose in this marketplace. We saw it for an absolute brief and fleeting moment on this Friday. And let me tell you something. If you go into intraday trade, you saw, again, it just, sink rapidly, though, right into the 14,000 level. We got just downright violent in trade. You have to anticipate the NASDAQ not only coming under 14,000, being substantially below that, okay, but at that point in time, okay, the markets, that's when we're going to start to feel like we are in the abyss. Again, NASDAQ, okay, under the 14,000 and S&Ps obviously descending into the 4,200 level. Again, those are key points to the low side. But hey, listen, NASDAQ finished at 14,013. I mean, it's on the cusp already and leaning over that edge. But in a moment, I'm going to tell you what I believe to be the most critical product. In addition to this, so we've got VIX ready to break out. We've got volatility and backwardation. You've got the bonds that are rallying, which is very much duck and cover. Dollar, okay? I don't want you to forget about the dollar. The dollar, which has actually been relatively mellow lately. I believe this is actually poised for a huge breakout to the upside. And again, I am in right now the long dollar business. I don't mind saying that at all. I'm actually long some dollar futures. This is actually small exchange. It's SPX H22s. So I'm actually long dollar in that particular trade. So again, any position that I'm going to talk about here, okay, believe me, I am in positions. I am heavily allocated at this point to a very large array of positions. So dollar poised to break out. Okay, inflation again to kind of explode, as I said, retesting the lows of 42.11, monsters of tech. This is one interesting aspect I also wanted to bring to your attention. When you start looking at the monsters of tech, the monsters of tech is your Apple, Amazon, Facebook, Google, okay, Microsoft kind of complex. Look at them on a year-to-date basis. They're down about 15%, which is for the most part right in line with the NASDAQ. But there's some interesting aspects of this. Okay, one of the interesting aspects is Apple. It's only down 8%. Okay. Amazon. Now, Amazon's only down 10%. Amazon took a steep hit early on in the year, rebounded off of its earnings substantially. I would pay very careful attention in NASDAQ to these two specific underlyings. Okay. Because at this point in time, you start looking around some of the usual suspects. You're like, look, there's starting to be real damage inflicted to even Microsoft. Okay. You look at Facebook, enough said there, it's down 40%. Google, okay, 10%. Google is also kind of on that dance floor, but Google will be, in my opinion, this is going to be the last underlying to actually get tagged inside of the monsters of tech. At this point, it's Apple, it's Amazon that would be on the dance floor. Everything else around us is taking substantial, okay, percentage hits, which actually brings me to one of the most critical points. The financials are actually going to lead, okay, the next stage and the next leg lower in the overall marketplace. Let's actually bring them up. The financials finishing this trading session massively unchanged. They were down 1 penny, okay? What is going on in here? Well, I'll tell you right now, okay? For me, at least at this point, a little shock, a little awe. It's because the bonds, they rallied huge. If the bonds are rallying, interest rates are coming off. If interest rates are coming off, why didn't they hit the financials? Well, most likely because the financials, as I said earlier, they closed like on the lower edge of their expected move. They pretty much held it together on that lower edge of the expected move. Nevertheless, I would fully anticipate, if you look at the year-to-date percentages here, the financials are totally unscathed in this marketplace. Okay, totally unscathed. As I just showed you a moment ago, the monsters of tech are down 15%. Okay, if you take a look around some of the usual suspects, I mean, everywhere you go, almost everything is down. Okay, the S&Ps themselves off about 9%. The QQQ, again, down about 15%. The Russell off about 11 to 12%. The financials, massively unchanged. The energy sector, I mean, the energy sector is up, but there's geopolitical risk in the energy sector. Nevertheless, I believe the energy sector will also come down, but it's the financials that are going to be near and dear to my heart. Take a look at the price action here. I mean, people, we're just a few trading sessions removed, if you will, from basically the all-time high inside of the financials. Always got to be focused on what is not getting hit in a marketplace that feels like it's on the edge. And the answer to that is it's the financials. So push all the levels aside. Yes, the NASDAQ is pretty much at, okay, check this out. We're about to close the futures. They're going to close them right at 14,000 on the button, right? So the marketplace feels like it's slipping off into the abyss. The NASDAQ, it already is there. What do you need for the next leg lower, though, in the S&P 500? And the answer to it is the financials. If you're looking, okay, to get involved on the short side, look to products that have fared relatively well, right? And that is, you know, like Bank of America is basically flat, and JP Morgan's down almost 6%. You take a look at Citi, it's up 1.6%. Wells Fargo, oh, here we go, people. This thing's up almost 10% in the year-to-date basis. Doesn't matter. Nowhere to run to, nowhere to hide. They're going to come for you. They're going to come for you, Wells Fargo, and they're going to sell it. Morgan Stanley also down to the tune of about 5%. Right now, if you're playing target practice, you're probably looking towards Wells, okay? You're probably looking towards Citi. And again, I wanted to be deadly specific with what I think is going to happen in this marketplace in the very near future. Again, trade throughout the next course of this week. It's a shortened holiday week. Doesn't matter. It's still going to be filled with economic tape bombs. We're going to go from geopolitical tape bombs to economic tape bombs. And those, they're going to be vicious. Any Fed speak over here, people, this is going to be on edge. And if you think that you're going to be able to handicap risk day to day, you won't. All you can do is sit back, okay, and pluck big specific levels. To the upside, 44.50. To the downside, the first target we have, 4,200. Put a target on its back because we're going to retest. And when we do retest, that's when there's going to be a little bit of violence in your trade. Last but definitely not least, of course, bring up the SPX. Now, critically important because the SPX, oh, this one's going to resonate with some people. The SPX in this past week of trade, okay, we had plus or minus $135 move being implied, right? That was what we termed the expected move. What was interesting about this last week of trade is we moved a little bit higher, dramatically lower. We ended the week. We didn't hit either side, either edge of that expected move. And I got to tell you something, I'm bothered by it. And I'll tell you exactly why I'm bothered. Because now we're coming into a holiday week of trade, and this holiday week of trade is going to take us down to 4 trading days. And in those 4 trading days, yeah, we're going to see plus or minus now roughly $121 expected move. So once again, as I said a little earlier, put on your big boy pants, because I'll tell you what, we are going to rock this next 4 days. And the interesting thing about this, if you take a look at the expected move, and again, there's no directional bias to that expected move, so don't try to imply anything. The only thing I can imply, the lower edge of the expected move this coming week pretty much correlates right into the lows. So the last time we actually had an expected move this low, yeah, that's January 24th. We actually hit the lows of the marketplace. So, I don't know, stick a fork in us and get ready for volatility to explode. It's going to be a big one. Listen, you got a marketplace that is clearly like it's right on that edge. You got at this point to understand intraday trade, there's nothing wrong with it. Okay, but you better have a phenomenal risk management plan. For those of you that are trading day to day, a little swing trading here, get in there, get defined risk, get in, get out, okay? There's no stops. You're going to get ripped apart. Use spreads. Last but not least, premium selling is beautiful. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.